Hi, everybody. This is Josh Jalinski, the financial quarterback, and we have exciting guest, Jeff Snider, head of global research at Alhambra Investments. He is not an economist, which is probably why he's been able to develop a working model of the global monetary system. His research is unique and informative in ways an economist would never consider. So we're going to go to the first question of the hour from Joe Carlasari. Joe, do you have any questions for Jeff?
Yeah, I'll kick it off. So my first question for you, Jeff, and again, thank you for coming on here, and I appreciate your time. I want to know what you think the effect, if any, or influence is probably the better word, of the QT that's going to start on June 1st from the Fed, particularly how they've had this sort of stepped up approach they proposed. And in particular, I'd like this, if you could focus your comments on the long bond, what if effect, if any, you'll see on the long bond with the QT they start ramping up.
Well, QT, like rate hikes, is all about making people think the Fed is doing something substantial. I think the vast majority of the public doesn't really know what the Fed's doing or what's on its balance sheet or what's not on the balance sheet, whether it's going up or down or anything in between. And really, it's more of a psychological tool than anything. The level of bank reserves really isn't material to the functioning of the financial system, and hasn't been for a long time. So the Fed is simply just trying to portray the image of a central bank that is extremely concerned about consumer prices and therefore is acting aggressively to try to tame consumer prices, whether it be through 50 basis point rate hikes, one after another, though we'll see how many they actually get, as well as running down their balance sheet, because by and large, most people have believed and have been led to believe the Fed has printed a whole bunch of money, therefore inflation. So it stands to reason, at least in the public mind or in convention, that if the Fed starts running off its balance sheet, it's tightening money, therefore it might have some kind of effect, sentimental or psychological effect on the real economy and consumer prices. As far as the long bond goes, once you get down the curve to the 5, 6, 7 year, the middle part of the curve, from that point on out, it's all about inflation and growth expectations rather than strictly or even much about the Federal Reserve or monetary policy. So that's why I think you've seen long bond yields hang in there relatively well, given the massive, the rather substantial sell-off that they've experienced over the last couple of months. But even though as consumer prices and consumer price rates have continued to be relatively high, you still see the 30-year long bond around 3% hanging around there. The yield curve is still inverted between the 7 and 10 year. So the bond market out past that, where the Fed doesn't influence it anymore, is still quite pessimistic on the way things are going to unfold from here.
So, Jeff, what does your research point to regarding the current economic state of the market?
Well, there's any number of things, and they're all kind of converging in the same direction, which is the bad direction. I mean, you got I think most prominently right now, you've got the US dollar exchange value, which is screaming higher against almost every currency on the planet, which is never a good sign. And then, of course, more recently, the last couple of weeks, the Chinese yuan has been caught up into that too. Although the yuan has been weakening since the end of February, it really has plummeted over more recently. So by just the US dollar exchange value, whenever it goes up, that's never a good sign, not just for people outside the US, but also inside the US, because a rising US dollar exchange value represents massive amount of pessimism as well as real money tightening across the global monetary system. And then there's any number of market indications that go along with a higher dollar, including, as I just mentioned, a slightly inverted yield curve. That's not good. A very heavily inverted euro-dollar futures curve. That market is still betting that at some point the Federal Reserve is going to stop raising rates and have to turn around at some point. Don't know exactly when. The market's sort of up in the air about how far Jay Powell can go before reality smacks him in the face. And then there's, interest rate swaps, for example. Swap spreads continue to be low and actually compressing when they should really be actively decompressing. So the massive, huge, multi-country spanning financial markets are all sort of like the rising US dollar, pricing in not inflation, but maybe even as much as recession in the US and around the rest of the world at some point, maybe this year, maybe next year, somewhere in between. We don't really know yet, but by and large, the probabilities that are motivating these markets have increased. That we've gone too far here.
Do you think we're in a recession
Josh?
now?
I don't think so right now, but there are a lot of things that sort of make you wonder. I just went through today, for example, the U.S. Energy Information Administration's data on things like crude oil production, crude oil stocks, which continue to be extremely low, which is why diesel and gasoline and oil prices continue to be high. But it may be surprising for some people to believe, some people to think, given that the oil prices and gasoline prices are high, gasoline and oil demand has gone the opposite way over really since oil prices spiked in late February, early March. So there's been a considerable drop in oil, actual products supplied is what it's called, into the marketplace, both gasoline and total petroleum, which suggests something is going on right now. And of course, you've seen trucking rates absolutely collapse, and sort of the precursor type of signals or warning signs that say that at the very least, we're heading into a downturn, and we'll see how far it goes. Again, we put that together with the rising dollar. You put that together with economic data, such as, let's face it, GDP was negative in the first quarter. The household survey was negative in April, whereas the establishment survey, labor market numbers was a little bit better, but the household survey dropped for the first time since 2020. So it may be that we're edging very close to recession, though I don't necessarily believe we're actually there yet.
So we're going to go to Joe. Next up, Joe, go ahead.
Yeah, I just had a follow-up, Jeff. So if there is a slowdown in growth or a slowdown in growth expectations for the real economy, wouldn't you expect 10-year yields to be peaking in this area and start to slowly decline from this? Are we near a cyclical top on 10-year yields for this cycle, or do you have a difference of opinion?
No, that's really the prospect we're looking for. The problem is we don't know how far the Fed will go, because that's what's pressuring interest rates right now is the front end of the yield curve, trying to get a handle on how far Jay Powell will get to go up in rates. And so the back end is sort of being influenced by the front end. The front end is really a political discussion rather than an economic or financial one. So it may be that the Fed can just continue to blindly raise rates for a lot longer than maybe anybody anticipates, or for a lot longer than the real economic situation actually demands. So it could be, and this by the way, this is how it usually works out historically speaking. You'll see the yield curve invert, but long end yields will continue to rise, pressured by short end rates, as central banks continue to hike rates inappropriately because they think the economy is doing one thing when it's actually doing the other. So it's not unheard of. In fact, it's actually typical for long end rates to rise until the market starts to really sense that the situation has turned a corner, and therefore it's going to be enough of an obvious turn in the corner that it will stop the rate hikes. That was the case in 2000. It was the case in 2006. And I don't know if we're there yet to have a handle on exactly just how far Jay Powell will get to influence the short end before the long end starts to really move down again. And there's any number of indications. I mean, some Wall Street firms that were extremely positive that there will be a number of rate hikes this year. Some of them have started to talk about a Fed pivot already, which suggests that maybe the Fed doesn't get as far as anybody believes currently, and that maybe the long end of the yield curve is closer to the top than maybe otherwise. But again, it's very hard to tell right now because there's so much uncertainty, especially given the fact that the Fed is operating basically on a political rather than economic or financial mandate.
Now, Jeff, you talk about parallels to 2018. Can you go through that? You have this chart on Twitter. It almost looks like a carbon copy of what's going on right now. Break that down for our listeners, the parallels between now and 2018.
There are it's pretty much everything, whether it's the dollar's exchange value, it's the flattening yield curve, and now it's inverted yield curve, spreads, everything. Essentially, we had the situation very much like last year in 2017, what was characterized as globally synchronized growth, which was supposedly this magic elixir of all sorts of monetary and fiscal programs that finally paid off. And the U.S. as well as global economy was going to fly away into the Hollywood sunset, and everybody was going to be happy. The dollar in 2017 fell in exchange value. The Fed started raising rates. It got into QT because it believed inflation pressures were building because of all that positivity in 2017. only from almost the moment the calendar changed to 18, the entire situation in real economy as well as in the financial and monetary system changed. So the dollar stopped falling and it started to go sideways and then started rising rapidly by the middle of the year. We had any number of collateral shortage indications, problems in the repo market, even the effective federal funds rate started acting screwy, spreads and everything else. The entire financial market started to price similar scenarios as it is this year, where it's saying, yeah, everybody in the mainstream is talking about inflation, everybody in the mainstream talking about only rate hikes to the future. The market started to prepare for the exact opposite situation, including markets like Eurodollar futures, where the Eurodollar futures curve inverted in the middle of 2018, which was a key warning sign that it was not working out the way that everybody thought it was. And of course, when you get to the end of 2018, yields started to collapse again, rate hikes disappeared. Jay Powell by early 2019 was doing the Fed pause. QT was abruptly ended in the middle of 2019. We got rate cuts rather than further rate hikes. There never was inflation. There never was recovery. And really by the end of 2019, before COVID showed up, we had recessions in Japan, Europe, and other parts of the world. Chinese economy had fallen off. And I think the US would have experienced a recession if it hadn't been for the coronavirus too. But the point being that the warning of that downturn in 2019 was all over the financial markets in 2018, even as the mainstream media, even as Jay Powell and everybody else said that, no, everything's fine, don't worry about it, everything's good, we're going to continue on as in rate hikes and everything else. The markets really nailed that one. And the parallels continue to show up to this year, last year and this year, where it looks like we're repeating the 2017 to 2018 inflection, maybe at some point last year. I mean, the yield curve started flattening way back in last May and then really picked up in October. Eurodollar futures inversion again in December 1st. So we're 6 months into that. And any of these, the rising dollar exchange value, which again, right around May and June last year really started to perk up. So any number of parallels to that 2017, 2018 inflection that are showing up or have shown up over the preceding months here in 2022.
So up next, I'm going to ask Jeff about the real estate market. Also, if this parallels to 2018, won't we also have a rebound potentially sooner than we think? This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback, with Jeff Snider, and we're answering all of your questions. So feel free to chime in on the Clubhouse chat box or message me, or you can call in. So folks, right now we're with Jeff Snider asking him about the real estate market. Next, we're going to go to John, who has a question on the real estate market. And then I'll ask my question on when do we see a turnaround in the economy? If the parallel is similar to 2018, will we see some type of 2019, January 2019 rebound? Maybe a suckers rally, not sure. But first we'll go to John. Okay, I'm having trouble hearing John. So
can you guys hear me okay?
Go ahead, John.
All right. So, hey, Jeff, thanks for joining us again. I guess with the spike in mortgage rates over the past few months, probably doubling or tripling from the 2s or low 3s, now pushing 4, 5, 6. What's your take on real estate market and the outlook for the real estate market based on those rates rising? What does that maybe mean for what the real estate market maybe thinks about what the Fed's going to do? And would just love to get your take on that. Josh had another question about stablecoins, but maybe we can push that to later in the thing because we had a podcast that Jeff did a few days ago that we were just listening to. So let me know if it makes sense to ask that later.
Go ahead.
The stablecoin thing, yes, that's a tremendously fertile topic, obviously, with Terra Luna blowing up within hours, I think, of Emil, my podcast co-host, Emil Kalinowski, posting that to his YouTube channel, talking about the concept of stablecoins. And we can get into that later if we have time, because I think that's still an interesting topic because there's a reason stablecoins exist. There's a reason stablecoins have been doing what they're doing. And I don't think that Terra is the end of the stablecoin at all. In fact, I think it's actually helpful because it's pointing in the direction of things that maybe didn't work. It didn't work so well that other groups and other projects can maybe learn from. So in the long run, it may be that this is actually positive, but that's, that's a separate issue for now. But getting back to the question about real estate, there's a couple dynamics at work there, not just in terms of interest rates, but also, what has been the source of strength in the real estate market over the last couple of years, really since the 2020 lows, and that's been investment funds. It's not been, realtors have been complaining over the last couple of years about the lack of inventory available for sale in the resale market because individual homeowners aren't really selling their houses. They're not really trading up to buy as they did in the middle or the early part of the 21st century. It's been entirely investment funds, mostly because investment funds are the only people out there, the only groups out there that have any liquidity or credit capacity. Banks and markets only want to lend to the most liquid credits, and that's really been investment funds who look at the real estate market and act in the real estate market very differently than individual investors or individuals who are looking at houses as a place to live rather than a place to make a return. So the interest rate plays a little bit differently into investment funds as they go with the interest rates, or as they go with the real estate market, than individuals do. And there's also the issue about NBS. There's some issues, hiccups in dollar rolls and hedging for convexity hedging in particular, that have caused a little bit of a melee in MBS, and in very similar ways to what we saw in, for example, the middle of 2013. If you remember the so-called taper tantrum, a lot of that was focused too on the MBS market, as everybody was getting prepared, at least being told to be prepared for higher rates from the Fed in 2013 and 2014. Those never happened, of course. But while that was still the mainstream belief, the MBS market was a complete mess in the middle of 2013, which spilled over into the treasury market, especially in the 7 to 10 year bucket, and all sorts of other financial markets too. But I think the upshot is that eventually these markets are going to settle down, though it's not clear how much of an impact that will have on actual buying activity in real estate, where I would tend to think it won't be all that good, not just because of interest rates cutting into the ability of borrowers to buy new houses, but more so the overall macro picture, which was a lot of ways similar to as it was in late 2013 heading to 2014, which was questionable at best. So I think that's a long way of saying that there's a lot more uncertainty in real estate right now than there has been over the last couple of years.
But I talk to people, they're still buying. I mean, I agree with you that I actually think the whole idea of BlackRock owning or whatever, name whatever fund you want buying apartment complexes and rents. I want to ask you a question about rents, because you mentioned that as on one of your tweets as sort of a rising component of inflation that people aren't realizing. I'm kind of worried about that. But the average person, I mean, I'm just, kind of people in my network, they're still buying. They're still seems a bit frothy. I mean, I could see if I was a betting person, I think we're sort of maybe 12 months away from the top in real estate, and we kind of have a decline. If you ever follow, I don't know if you're a cycles guy, but if you follow the real estate cycles, there tends to be a cycle that bottoms about 3 to 5 years from the top. So if we're kind of at the peak, maybe we experience a bottom in real estate prices 3 to 5 years. Do you subscribe to any of those real estate cycles theories or no?
Oh, absolutely. I think there's a reason why most people do. And I think most people actually do. And I think you're right, Josh, because the housing market isn't falling apart. Let's be clear. I mean, we're not talking about the housing market or housing bust or crash 2.0 here. We're just talking about what looks like maybe the moment of inflection where uncertainty becomes more of an issue than it was, certainly 6 months ago when the housing market looked indestructible. The real estate market was indestructible. And again, it's been investment funds that are behind a lot of this, which is one reason why rents are rising, because eventually, as investment funds have been paying higher costs to buy and develop properties, they're going to want a return on their investment. And that's kind of what we're seeing in rents, especially since a lot of rents have been subsidized over the last couple of years by governments, which creates an added component of purchasing power in the rental market, which, again, they're trying to capture as much as they possibly can, which is understandable, except that we're not experiencing an actual economic recovery or boom. So those rising rents become another source of consumer pain and another angle for demand destruction that eventually leads us into the wrong direction, which might be at least a downturn, maybe a recession at some point, because the cost of necessities that are going up, whether it's rent, whether it's gasoline, whether it's food prices, in an environment like this, those are only subtracting from future growth and future activity.
Good point. Next up, we're going to go to Tina. Go ahead, Tina.
Hey, Jeff. Hold on, I'm going to take my AirPods off and clear.
Okay, go ahead.
Can you hear me?
Yes, go ahead.
Okay. So there was a tweet, a quote tweet that I want to read to you, and I'd love to get your comment on it. So somebody who is at a conversation with a guy named Harold Malmgren. Let me just read this. Discussed with Harold Malmgren, Norway's sovereign wealth fund and Swiss National Bank, who will buy equities at the direction of Janet Yellen. Harold Malmgren commented, yes, Albert has it right. Treasury is quietly aiming at a dollar index of 110 by summer, hoping the world's biggest asset managers will ramp up U.S. stock purchases to assist avoidance of U.S. equities crash. With 110 plus, where else could they go? P.S. dollar shortage showing up in rising reverse repo fails. So I was just curious to hear your comments on that, what you thought the impact would be of Dixie at 110, and what you make of this tweet.
Well, I have no idea what to make of the tweet. It's not something I heard, and it's not something I really put too much stock in. Those types of conspiracies, that they never pan out that way, and that's really not what the government is really. I mean, the government trying to raise the dollar index or just the exchange value of the dollar simply because it wants people around the world to buy U.S. equities. That's too far into the weeds for me, because there's no reason for it. Look, the U.S. dollar is not going up because Janet Yellen wants it to. The U.S. dollar is going up because the dollar is becoming short around the rest of the world, and the reason the stocks are going down is because a lot of the things that are going on, or a lot of the assumptions that were taking place are allowing people to buy stocks and hold stocks over the last year have to be rethought. And the big one is everybody believed that Jay Powell and the Fed was their best buddy. Now all of a sudden they realize, oh, Jay Powell's not there. Whether he is or not doesn't matter. There's a sentimental impact there. And unless that changes anytime soon, I think stocks are going to be weak. And then stocks are now confronting the same economic circumstances that the rest of the markets are pricing already. And it's a volatile mix. I'm not sure Janet Yellen has much to say or do about that, nor can she lead foreign sovereign wealth funds to take advantage of a rising dollar, which is materially bad for everyone around the world, usually producing risk aversion, not risk taking, and then leading that to rescuing the stock market so Jay Powell can continue his rate hikes and not do it himself. I think there's just too much there.
So, you had a follow-up?
Makes sense to me. No, it doesn't make sense, and it seems that a dollar index going up like that is negative for asset markets as well as economies.
Yeah, but there's always there's always been this belief that currencies, whether it's the U.S. dollar or foreign currencies, are under the direction or under the control of governments, and that Treasury, if it wants something, or if the dollar's rising, it must be because the Fed wanted it or the Treasury wanted it. And so we got to reverse engineer how this could be the Treasury Department doing something. I think once you realize that the Eurodollar system is in control of all these things, you can break yourself free of these conspiracies and just say, look, Treasury's along for the ride as much as Jay Powell is, as much as Xi Jinping is, or everybody in Japan. The tweet, I think you mentioned the tweet, repo fails and things like, yeah, there is an enormous collateral shortage that has hit the system over the last 6 weeks or so, massive collateral shortage that is more likely to be having an impact in the US dollar, as well as all the rest of these markets, than anything Janet Yellen has ever said or done.
Another listener has commented, wants to ask you this question. If the ECB and the Bank of Japan start raising rates, will that escalate the downturn? Or would that be the inflection point for the dollar to fall and equities to rise again?
Well, that's an interesting question because number one, the ECB and the Bank of Japan they're allowing themselves to diverge quite a bit from the Federal Reserve. And you have to ask why that is. I wrote not long ago, maybe I owe Christine Lagarde an apology because I figured she would be like Jay Powell, headlong into hawkishness, trying to get rid of QE and then doing her own schedule of rate hikes. But to her credit, I think, we'll see if it continues, the ECB has been very methodical, very deliberate about moving toward winding down QE. They're still doing QE, winding down QE and getting to rate hikes because I think, unlike Jay Powell, she doesn't have the same political pressures. And I think even more than that, economic weakness and at least economic uncertainty in her own backyard, especially the close relationship between Germany and China, is far more visible and obvious than it is here in America. So, I wonder if maybe there's a reluctance that we should be looking at with the ECB rather than, whether or not the ECB starts hiking rates, that plays a role. It may be the fact that the ECB has refrained from following the Federal Reserve that is the result and the outcome that we should be focused on right now. And if they do start, if they're going to wind down QE, maybe if they do start raising rates, I don't think that necessarily changes the picture because I think markets they've gotten the message that Europe is going to go slow. In Japan, if they ever stop a QE and actually get to a rate hike, I will be totally shocked because Japan doesn't do that. Japan is perpetual QE forever. Japan is zero rates forever. And I don't think they're ever going to find their way out of it. Certainly not now with their close, again, the Chinese relationship with them. The Japanese economy is probably further along in terms of trouble and downturn than even Europe is. So I think the markets understand that the reasons why there's so much more caution in Japan and Europe is because, unlike the Fed, they have to be more cautious in Japan and Europe. And so even if Europe does get to some rate hikes, I don't think it makes a big change in the market posture. Maybe if the Europeans all of a sudden throw in the towel and say, we're going to start doing, 50 basis point rate hikes like the Fed one after another, maybe that does something. But I think for right now, the markets are have pretty much settled on Europe going very slowly.
So we're going to go to the YouTube question box. And folks, follow us on YouTube. Subscribe to my YouTube channel, The Financial Quarterback, Josh Jalinski. Also look up anything by Jeff Snider and Emil Kalinowski. I think I'm saying that correct, right, Jeff? Fellow Polish guy.
Yeah.
And somebody on the YouTube, you have this globe, and someone has commented, "Isn't the globe obsolete?"
Is it? I don't know. I grew up in an analog world, so there's still some benefit to having some analog tools laying around, if for no other reason to remind us of progress in technology.
I have our kids. We school our children in a classical methodology, and our 7th grader has to point to a map, name a country, capital, rivers, and my 10-year-old knows where the Yellow River is, not with no markings on the map. And I think geography and kind of the move of the culture away from geography is why people are so dumb economically. They just don't have the whole global perspective. So I actually love the globe. And maybe that's why you think a little differently.
Yeah, I do too. Again, like I said, I think there's some benefit to actual touching and feeling and thinking and doing things. And you're right, Josh, because in terms of just economic illiteracy, for the last however long, a couple decades longer, we've been told not to worry about it, right? Don't worry about the economy. Don't worry about the financial system. The Fed's got it under control. Everybody, the government's got everything handled. Don't worry about it. Don't think about it. And I think, again, having one foot in the analog world forces you to sort of think for yourself a little bit, which I think people need to do more of.
And I think you think of parallels between where we are and where Japan was in the 90s. And you see China, and you see, and I want to get your thoughts on China. For years, I'm my show, WOR, one of the biggest shows in the country. We're on New York radio every Saturday and Sunday at 9. And people, I think I was the only commentator for years to decry China's one-child policy. because I saw it 10 years ago, the economic Armageddon that the Chinese will face. We will not, I don't think we'll see anything like it, because they just don't have enough children to replace the consumers. So they've built this whole, and if you think about it, people are just economically dumb. That they just think a one-child policy or having less children is good for an economy, where every economy that has seen boom cycles, their children replace each other, but nobody studies history or geography and the parallels with economics and finance and monetary policy. So we're going to go to some YouTube questions, then we'll go back to Clubhouse questions in a moment, but just so the YouTubers don't feel left out. Someone says, doesn't it seem as though there is a recession or crash every 10 years? Cycles gurus will talk about the 7-year cycle, 1987, 94, 2000 to 2002, 2008, 2015, there was like a 15% dip. Now 2022. Do you give any credence to that kind of 7-year boom bust cycle?
I think since 2008, it's actually been a 4-year cycle. And relatively speaking, it's not exactly 4 years, but you can actually time it to about every 4 years. And it almost looks like the presidential election cycle, which I think is more a correlation than actual causation. But 2008, major recession. Then you fast forward 4 years, 2011, 2012, the US very closely skirted a recession while Europe actually fell into one. Then you fast forward 4 more years, you get to 2015, 2016. Again, the US barely avoided a recession in especially late 2015, early 2016, while the rest of the world, many of the emerging markets actually experienced a real depression. China fell off really, really hard, as well as a lot of countries around the world. Then you fast forward 4 more years, you get into 2019, 2020. I mean, I'm not talking about COVID because that was obviously something nobody predicted. But, as I said before, the 2018, 2019 cycle, by the end of 2019, long before the pandemic had arrived, there was recessions in Japan and Europe, especially Germany, and it looked like the US was heading toward one as well. So it seems like these cycles are almost every 4 years, and you have to wonder if we're into another one of that 4-year cycles, maybe have they sped up a little bit? If it was 4 years from, you say, 2019 to 2023, maybe it's now 2022, but still, it's a more regular global cycle than, I think, every 10 years recession. I think that's probably a little bit too far apart, especially given what's happened especially since 2008.
Yeah, with all the government malinvestment, it now seems like it's every 2 years. And Stan, who we've had on, points to like a 34 to 40 week cycle that he sees pretty recurring. Okay, we're going to go to Hodl up next with a question on Clubhouse. Go ahead, Hodl. You're on.
Hey, Jeff. Good to talk to you again. I know I've heard you state in the past that, sort of your belief is that the Fed is primarily a communications tool, and I want to get your take on something they've been communicating lately. Powell has used the term softish landing, and I'm curious what you think he's trying to communicate with that terminology.
What he's saying is that he realizes the rest of the marketplace is a complete and utter mess. And so he's worried that the public is like inflation or like consumer prices. He's worried the public is getting the impression that the Fed is their heads up in the clouds, and they have no connection to what's going on in the real markets and the real economy. And so he's trying to impress upon the public, because everything is about public messaging. What he's trying to impress upon the public is, yeah, we noticed that markets have gone in the opposite direction. There's a lot of quote unquote volatility or froth, whatever you want to call it. And so the Fed is going to, you better believe it, closely calibrate and absolutely skillfully implement its monetary policy so that we get rid of inflation and the economy softly lands right where we want it to be. Of course, it's absolutely ridiculous, but it is the Fed acknowledging that already just 2 rate hikes into his cycle, things appear to be going seriously wrong.
Any follow-ups on that, Hodl?
No, that was interesting. Thanks, Jeff.
Next question, Matthew, go ahead. I don't know if, okay.
Oh, hey, I'm here.
Yeah, go
Hey,
ahead,
Jeff.
Matthew.
It's great to have you here. I was just curious, you were mentioning Japan's situation. Do you see us getting to a situation like Japan eventually, where we have to do constant QE or where we can never raise rates above a certain level? Do you think we're there now?
I think we were there about 10 years ago. We're never good. Things are never going to repeat exactly. We're never going to be exactly like Japan, where the Bank of Japan, really since 2013, actually going back to 2009, has been doing QE nonstop. I don't think we'll get to that situation. I don't think we're that far gone, but there's more similarities than not. And so, yes, that's why interest rates continue to be low despite what happens in consumer prices. That's why the Fed is more likely to be doing something quote unquote dovish than these small windows that come along every once in a while that at least let the Fed think that it can raise rates, and that though it's not, again, it's not as bad as say Europe or Japan itself, but the whole world has essentially fallen into a Japanese type situation, and for many of the same reasons, which is, as Josh was just alluding to, everybody has outsourced their thinking on economics and finance to everybody else, to government officials who continue to just do the same things over and over and over and over again, and shockingly produce the same exact results as we've seen throughout history. So until that kind of a cycle breaks, until we start getting people to think about things outside of QE, interest rates, Fed, central banks, and everything else, and start looking at actually what is really wrong here and has been wrong for a long time, we're just kind of stuck going down that same road. It's not exactly the same as Japan, but I guess I said it's way too close.
A great point. So the next question, Jeff, do you think that the Bank of Japan starts QT by October?
Not a chance. The Bank of Japan, whenever they start thinking about doing something as far as winding their programs down, it never ever works. In fact, it's almost you can almost set your watch by it. Go back to 2018 again, another one of these parallels. The Bank of Japan started openly talking about exiting their QQE in February and March of 2018. Within, I think it was 4 weeks or 6 weeks, they were already talking about upping their QQE again. So no, I don't think the Fed gets, or the Bank of Japan gets the quantitative tightening, let alone rate hikes.
Next up, we're going to go to Will, and then I'm going to ask you about the euro. Go ahead, Will.
Oh, hey, Jeff. Yeah, thanks again for this. I was just going to ask you if you think this is the Fed Treasury Accord-like inflection point with Powell, or if we're going to in 1951, or if we're going to go back to business as usual, where the Fed realized we screwed up, let's keep growing the balance sheet and let's keep monetizing.
It's interesting. I think this is now actually the flip side of that, the other opposite bookend, where in 1951, the Fed famously or infamously, triggered almost a crisis in the bond market by refusing to subsidize certain Treasury auctions, which the Fed or the Treasury Department wanted because of the Korean War that was just starting to break out. And eventually, as the story goes, the Fed achieved its independence from Treasury, where it had been basically second fiddle to Treasury since the Great Depression, for good reason. I actually think this is the opposite of that. I think the Federal Reserve has fallen under Treasury once again. That has become part of the political apparatus. Despite the fact that they're going to claim that they're still independent, these rate hikes are pure political theater, and you can tell they're driven by politics, especially that last ridiculous, absurd press conference that Jay Powell gave, where his opening statement was a message to the American people, basically telling them, a la Bill Clinton, I feel your pain. That's not a central bank. That's a politician, like the Fed is running for office. And that wasn't something Jay Powell wanted to do. That was something he was forced to do for various reasons. So I think the Fed has essentially very publicly ditched its whatever independence it ever had, and has gotten with the political program to join the appearance of trying to fight inflation. So to me, and again, as I referenced earlier, I think that's really one of the reasons why the yield curve has been so topsy-turvy over the last couple months, because it's very difficult to predict how a political policy is going to play out as opposed to something that is actually anchored in real economics and finance.
Thank you, Jeff.
So does the Fed have any credibility left?
No, I think the question that was just asked about the soft landing, I think no, because, as I referenced earlier, some of the Wall Street banks who are, some of the biggest Fed's cheerleaders, they've already started talking about a Fed pivot. And let's not forget, we just did this a couple years ago. You get to the end of 2018, the entire global economy is falling off. The entire marketplace is a mess. And the Fed is saying, no, we're going to continue hiking rates on into 2019, only to have to turn around within weeks of their last rate hike to say, oh, maybe things aren't going so well. So they just did this a couple years ago. And if the same kind of scenario plays out, what credibility do they actually have left to begin with? I'm not sure they have a whole lot, especially in terms of consumer prices, because I think most people know that the Fed isn't going to be pumping more oil out of the ground. The Fed isn't going to be shipping empty containers back to China or moving railroads out of Chicago. The Fed has no real ability to influence consumer prices unless you actually believe they have that ability, which I'm not really sure people actually do, which is one reason why I think more consumers are more afraid of a recession than anything else at this particular moment in time.
So for people who are not familiar with your work, just tuning in maybe to hear you for the first time, describe your general thesis on the Fed and your general thesis on the Eurodollar futures market.
Well, it's not just Eurodollar futures.
Whatever, yeah. Give
how
people.
Much time do you have?
However, I think you have to leave us in a short while.
Yeah,
I think you have. Just in a nutshell, I guess.
What happened was we had monetary evolution a very, very long time ago. It really started in the early 1900s, but it really took a turn in the 1950s with the arrival of something called the Eurodollar. What was used to be Eurodollar market, now it's actually a full-fledged Eurodollar system, which essentially banks evolved as well as forms of money evolved, so that by the 1960s and 70s, Bretton Woods didn't break down in August 1971. The roles of the actual global reserve currency had been absorbed by the Eurodollar system throughout the 60s and into the 70s. So when Nixon turned the lights out on convertibility in 71, that was sort of a ceremonial end to what had already ended many, many years before. What essentially that meant was, because of this massive bank and money evolution, including much of this monetary system taking place outside of the United States, even though it's ostensibly denominated in the US dollar, it was outside the jurisdiction of the Treasury Department, the US government, as well as the Federal Reserve. As a bank-centered system, it didn't leave much room for central banks because, by and large, they couldn't monitor what was going on in the offshore system, nor did they really make an attempt to keep track of what was happening in it. So around the 1960s, 70s, and 80s, central banks made a conscious effort that they were going to stop following the monetary system. They were going to remove themselves entirely and try to influence behavior instead, the psychology of expectations management, where Alan Greenspan would raise or lower the federal funds rate a little bit here or there to try to signal to banks, consumers, as well as businesses, whatever he wanted them to do. And that all seemed to work very well only until around 2007. And the only reason it seemed to work very well is because this Eurodollar system kind of hit its groove to the 1980s, 1990s, and early 2000s. Of course, then it went way too far, led to the housing bubble, credit bubble throughout the rest of the world. And then it broke down in 2007 and 2008. But because the Federal Reserve isn't actually a central bank and doesn't actually get involved in this global monetary system, there was no way to stop what was really a major monetary crisis, a global dollar shortage. And the problem that we have today is that the Eurodollar system didn't experience a temporary but severe spasm in 2008. It was actually representative of a clear change in condition, a structural change, a paradigm shift. And the Federal Reserve has simply just been a bystander ever since, trying to fool people with its QEs and trying to influence psychology rather than actually do much about the monetary system itself. And that's why you see, why we said the US is following the Japanese path. That's why interest rates only go lower. That's why there really isn't any actual inflation, even though consumer prices, yes, I know they have increased over the last year, but that isn't of the monetary variety. That was a supply shock. And so by and large, we have a global reserve monetary system that has existed for almost 3/4 of a century that hardly anybody knows about, hardly anybody understands very well. And that includes central bankers and government officials.
A very good point and good synopsis. But where is this money? I mean, just as like a Joe six-pack question. Like, I know it's all digital, but
that's it. That's
so
the key innovation, and that started
but where
way,
is
way
it?
back.
Where is it?
It exists on the balance sheets of the banks that operate within it. So essentially, it's ones and zeros on JP Morgan's or Deutsche Banks or UBS's or the Industrial Bank of China or
but
really
how is
a lot
that
of the
deposited?
Japanese banks.
Did they just make it up originally? Just like a
it's
charade?
all the stroke of the bookkeeper's pen. Now, it's not that simple. It actually does get complicated. And there are actually constraints on the creation of digital ledger money. But that gets into balance sheet construction and some regulation. But mostly, by and large, it's about getting other counterparties to trust what you're doing, which is one reason why there are so many derivative contracts out there, because that's really balance sheet tools. But if you're asking where are these euro dollars, they don't exist. It's a reserveless virtual monetary or virtual ledger money system that goes way, way, way back. There aren't physical Federal Reserve notes. There's no dollar bills out there. There's no gold. There's no coins. It's all digital ones and zeros. It's essentially what cryptocurrencies have become, which is a distributed ledger system, except that the Eurodollar system was narrowly distributed, whereas cryptocurrencies seek to get into a much wider and very much more open and transparent ledger system.
Okay, next question. Do you think the curve will invert again? And a follow-up, how much more do you think the Fed hikes rates?
Well, the second question is very difficult to answer. I tend to believe that maybe we're closer to the end of the rate hikes than not. But again, I mean, who knows with the Fed, what kind of political pressures that they'll continue hiking into a recession. That isn't actually unheard of either. That could possibly happen. And then as far as the other part of the question, what was the other part of the question?
But you believe, though, let's say, even though the Fed hikes rates, they're sort of powerless. It's just political. If we're going to have a recession, we're going to have a recession regardless of what the Fed does.
Yeah, exactly. Again, the rate hikes are not going to get more oil up out of the ground. That's the reason why oil prices continue to be high, why diesel prices continue to be at record highs in gasoline, is because that suppliers have been unwilling to drill more oil. And one of the reasons why is because they know every time the oil prices go up, they go right back down again. And they remember 2014 and 2015 when a lot of weaker oil producers went into bankruptcy. So there's no incentive to actually chase oil prices at this level. And so how are rate hikes going to help the situation in the oil market or the energy sector? They're not really going to do that at all. And so what is the Fed really trying to do here? It's really all about trying to convince the public that they're doing something about inflation, because let's face it, we've all been taught since Economics 101 that if you want to control inflation, you have to hike rates. Now, whether that was ever true or not, that's debatable, and I would say that it's not, but that's what we've been taught, we've been told to believe, and a belief that has been reinforced time and time and time again over the intervening decades, and everybody just accepts that that's what happens. The Fed hikes rates, that's equivalent to tightening. Nobody ever stops and thinks, is it really? How does that really work? It's all about psychology.
Next up, we're going to go to John with the question on stable coins in wake of the Luna collapse.
Just a circle. Well, I mean, I just found it fascinating because you and Emil did an episode, I think it was like 208, where you first kind of introduced, like, it sounds like you think it could be a favorable tool in some ways to be able to, like, manage the elasticity of money, as I think you put it. You sort of, in your last podcast a few days ago, formatted this, like, stability question and whether it needed to be, like, measured against an actual value in the form of a dollar or euro, or whether something like CPI, a basket of goods or something. I'd love, one, now that you've seen this Terra Luna collapse after the episode, love to get your take on anything you've seen. Would love to see, like, if you can expound on the stability component that you talked about in the podcast a few days ago. And finally, without loading up too many questions, and I'm happy to remind you if you forget them, like, I'd love to get your thoughts on how you think a system like this could be designed. Inevitably, these all feel like Ponzi's, and I just don't know that we really are able to have a decentralized stable coin, as you kind of talked about a few days ago. So I'd love to expound on that with our last few minutes, if you don't mind.
Well, for one thing, I think people don't realize how much, or how, they've been using digital currencies for basically their entire life. when you ask somebody what is money, inevitably they say, well, I have currency in my pocket. Well, that's not what people use. People use credit cards, debit cards, electronic transfers. Even writing a check is a form of digital payment. It's a form of digital money. So I think by and large, that's part of the problem, is that people don't really realize we've been in a ledger digital virtual reserveless system for as long as we have. And I think when they realize that, it's not as big of a transition, certainly not as big of an intellectual hurdle to move into a more widely distributed ledger system like a cryptocurrency, especially given the fact that, you know, they would be more open and more transparent. And when you really boil it down to basic cases, what is it that your bank actually does? It's not a store of physical cash, because nobody uses cash, and nobody's used cash really in any substantial amounts in over 100 years. So banks are nothing more than glorified bookkeepers, which is really all the blockchain is. We don't need banks. We don't need to be doing those types of things. We don't need to be looking over our shoulder and privileging these special corporations and giving them all sorts of power that they don't provide any value to. So moving into a widely distributed ledger system, I think will free up a lot of intellectual capital as well as real capital too. But as far as stable coins themselves, the reason they came about and the reason we were talking about them is because the Eurodollar system itself, since it broke down in 2008, sort of opened the door for competing currencies, not because the Fed is destroying the dollar, but because the Fed doesn't do dollars. And so there's this need, there's a very deep historic need, whenever you have a tight money situation, that human beings create different ways of getting elasticity out of currency. It used to be called ghost money or virtual currencies. They go way back to the 13th and 14th century. So in that sense, digital currencies are nothing new. And then the first digital currencies out of the box, Bitcoin wasn't first, but was one of the biggest ones, obviously, and sort of the first one that really caught on. But then Bitcoin became enormously volatile, starting in 2017 and then crashing in 2018, then surging and up and down over the last couple of years. And so there you have the first, the tier one digital currencies that were not really suitable as a medium of exchange, which is really what needs to happen here, not the store of value that everybody seems to be piling into these things over. And that obviously opened the door as the pendulum swung in the other direction. If Bitcoin and Ethereum are going to be ridiculously volatile in terms of price, why don't we have something that's actually stable? So to see if we have something that's stable, that could therefore prove a much more useful medium of exchange. But that gets to a bunch of thorny issues, which is what Emil and I were trying to explore with Nick Black, which is how do you define stability? And the natural answer is like a money market fund. Let's define stability as $1 for 1 unit. And so a lot of these stable coins, the collateralized stable coins, are essentially money market funds with a digital token attached to them, which kind of makes some sense. I don't particularly think that's the way to create stability. And I believe I said that both times that we raised the issue on the podcast. So to me, the fact that Luna and Terra blew up over the weekend, not really surprising, because I don't think pegging a coin to $1 is the right way to define stability. And I think there are other ways to do that, because by and large, the goal here is what we've never really been able to do, at least never been able to do efficiently, which is we need to match the supply of money with the demand for money, and realizing that that's a dynamic relationship. It's not a static relationship. So we want to have legitimate money supply for legitimate money demands, which is, those are obviously open questions in an ideal framework. And I think that digital currencies in some form or another do offer us a way to do so, and to do so more democratically than instilling this fake or real power in centralized authorities like central banks. So that's really the hope that we express, or the optimism we expressed, is not in the crop of stable coins today, but in the exploration of these topics and the exploration of these needs and functions, that maybe down the road we start putting the real things together, so that even learning from the failure of Luna and saying, okay, this is what went wrong, let's not do that again. So that's really the issue here, that the door is wide open for competing currencies. And that's the reason why you've seen the proliferation of so many digital currencies, as well as DeFi all over the place, is because there's opportunity to be had here. And there is real innovation, real useful innovation of this very disruptive technology. It's a very messy process.
Yeah, I don't trust most of them. or all
And you
of them.
should know that's.
I mean,
most
I
of those
think
digital currencies are just garbage. A lot of them are scams. A lot of them are just bad ideas. I think
Jeff, do
the
you mind
problem
if I
with
follow up on that thread? Do you mind if I follow up on that thread? Because in the same podcast, you talk about the importance of decentralization, and I just heard you kind of talk about the need to, if you were almost designing a new financial system, like you wouldn't even use banks, if you will, right? And my take on it is then, why not maybe, look at something like Bitcoin, and looking to improve on Bitcoin, which we know is really the only decentralized protocol of these 15,000. And so, like, to me, all of the tinkering that we're talking about, I wonder if it all just makes sense to move towards something that is actually decentralized, and even acknowledged by our own government as such, right? And treating it as property. So, like, I wonder what your take is on just like focusing some of that brain drain into the innovations.
Well, we got 2 minutes, so 2 minutes to answer the question, Jeff.
Yeah, I gotta get running here. And it's a great question too. And I'm going to do. I'm not going to do it nearly.
Yeah. What are your thoughts on
here.
Lightning or some other ways in which you could have elasticity, and you could boil things down to Satoshis, and I mean there is some elasticity there. But go ahead.
And I think the problem with Bitcoin is that yes, it gets correct. The idea of decentralization is completely separate, but it's not a useful medium of exchange. I don't believe that fixed allotment currencies will work. I think that will always lead to a situation where money pools, it gets hoarded, and then the economy suffers for it, because history has shown that's the case. And in every one of those situations, a competing currency will always be issued, because elasticity is what the commercial system actually demands.
Well, I want to thank you for joining us.
We could argue this for days.
I want to thank you, Jeff, for joining us. Very fun interview. Thank you for all of your great questions on Clubhouse and YouTube. Folks, if you want to catch more, you can follow us on The Financial Quarterback, Josh Jalinski. Also, Jeff has a great podcast. So, folks, make sure you subscribe to it. What is it called again, Jeff? Eurodollar University. Right? Oh, good. I remembered it. Eurodollar University. And also subscribe to his YouTube channel. What's your YouTube channel?
It's actually Emil's channel. So it's Emil Kalinowski, Eurodollar University.
Wonderful. Eurodollar University. Up next, we have David Ranson, former University of Chicago economist. That would be a fun debate between, like, you're like the new school, he's the old school. We got to get a round table with you, Lacey Hunt, David Ranson. That'd be fun. So thanks so much, Jeff Snider, for joining us. We'll be back after these messages.
All right.
Thank you, Jeff.
All right.
Thanks, Jeff.
Yes. Take care, everybody.
And then Clubhouse.